I want you to think about something very carefully before we get into the data. Right now, on Saturday, April 11th, 2026, silver markets are closed. The price on your screen, $75.60 per ounce from Friday's close, is frozen. Nothing is trading. No retail investor in the world can buy or sell silver right now. But here's what most people do not understand about closed market weekends. The market being closed for retail does not mean nothing is happening. It means the people who operate outside normal retail market hours. The institutional trading desks, the sovereign wealth fund managers, the commodity hedge funds running 24-hour global operations, the banks with direct access to over-the-counter silver markets, the physical bullion dealers coordinating with Asian refineries are all actively working right now while you cannot. They are positioning. They are analyzing the Islamabad talks outcome in real time using intelligence resources that retail investors do not have access to. They are looking at Strait of Hormuz shipping data from K-Peeler and Lloyd's List maritime tracking systems that update continuously. They are reading IRGC communications translated by private intelligence contractors. They are talking to Pakistani government officials through back channels. They are building their Monday morning position before the Globex Open at 6 p.m. Eastern Sunday night. And by the time retail investors wake up Monday morning and check their phones, the move will already have happened. The gap will already be established. The opportunity or the damage will already be locked in. This video is my attempt to show you what the institutional playbook for this specific weekend looks like, based on publicly available data, documented historical patterns, and the specific mechanics of how large money moves in silver markets during binary geopolitical events. What they are planning for Monday's open is not a secret in the conspiratorial sense. It is a systematic, data-driven, risk-calibrated institutional response to a specific set of market conditions. And understanding their playbook gives you an edge that most retail investors simply do not have. Let me start with who specifically is doing the planning I am describing, because naming institutions with documented positions and strategies makes this concrete rather than abstract. JP Morgan Chase holds an estimated 750 million ounces of silver in COMEX positions, representing approximately 40% of all COMEX silver futures contracts. This is not speculation. It is derived from CFTC commitment of traders' reports and documented delivery activity. JP Morgan in January 2026 issued 99% of all delivery notices on 8.1 million ounces in a single day, functioning as the primary seller of physical silver into the delivery system, while simultaneously maintaining massive long positions in paper silver. What does a firm holding 40% of COMEX silver futures do on a weekend when a binary geopolitical outcome, Islamabad talks, is going to gap the market when it reopens? They position for maximum optionality. JP Morgan's trading desk does not predict binary outcomes. They build positions that profit from the volatility itself regardless of direction, while simultaneously having physical inventory that benefits if paper prices are driven down by a gap down, because they can accumulate more physical at discounted prices. Their Monday morning plan is not bullish or bearish. It is structured to profit from the gap in whatever direction it goes, while using their scale and market access to influence which direction that gap goes. A firm controlling 40% of COMEX contracts has the ability to create the gap it wants. Not perfectly, not with certainty, but with enough influence to tilt probability meaningfully in their preferred direction. And their preferred direction this weekend is almost certainly a temporary flush to lower prices that allows them to accumulate additional physical at a discount before the structural bull case reasserts itself over weeks and months. Now let me show you the specific evidence that a flush is being prepared based on the CFTC data released Friday, April 11th. The Commitment of Traders report, which shows the positioning of different categories of market participants as of Tuesday, April 8th, reveals something critically important that most silver channels completely ignored this week. Managed money traders, the category representing hedge funds and systematic trading funds, cut their net long positions in silver by 5,000 contracts to just 23,400 contracts. This happened during the same week that silver posted its best weekly performance since late February, gaining over 4% from 72.26 to 75.60. Let me state that again clearly because the implication is significant. The week silver had its best performance in months, the smart money was reducing its silver long exposure by 5,000 contracts. This is textbook pre-binary event de-risking. Managed money funds know that Islamabad is a binary outcome. They know that if talks fail and silver gaps down $6 to $8 on Monday, they want their exposure reduced before that gap happens. So they sold into the ceasefire-driven rally this week. They sold their silver when retail investors were buying the ceasefire headlines. They reduced net longs by 5,000 contracts while pushing price up enough to generate the retail FOMO buying that absorbed their selling. Now those 5,000 contracts are sitting in cash, waiting for what? For Monday morning's gap to establish the new direction, and then those 5,000 contracts get redeployed on the correct side of the move with full information about which scenario Islamabad produced. This is the institutional playbook for binary events. Reduce exposure before the event. Let retail absorb your selling into the pre-event rally. Redeploy on the other side of the gap with fresh capital and confirmed directional information. The 5,000 contract reduction is not a bearish signal about silver's long-term outlook. It is a tactical de-risking before a binary event. And those 5,000 contracts coming back into the market after the Islamabad outcome is the institutional buying wave that will drive silver's next directional leg, regardless of which way it gaps. Here is the Strait of Hormuz data that the institutional trading desks are looking at right now on Saturday, April 11th, that retail investors are not tracking but absolutely should be. Maritime data from KPLR, Lloyd's List Intelligence, and ADNOC, the UAE's state oil company whose CEO stated explicitly on April 9th that the Strait of Hormuz is not open, shows the following pattern since the ceasefire was announced Wednesday, April 8th. Wednesday, 8 ship transits. Thursday, 4 transits. Friday, 2 transits. The trend is deteriorating. Day by day since the ceasefire was announced, Hormuz traffic has been declining rather than recovering. 600 vessels, including 325 tankers, remain stranded in the Persian Gulf. Iran's Islamic Revolutionary Guard Corps has confirmed it is routing ships through narrow designated lanes it controls, and has destroyed 16 mine-laying vessels. Does not mean the mines themselves have been cleared. The U.S. military confirmed it destroyed 16 Iranian mine-laying vessels, but destroying the ships does not clear the mines already deployed. The strait has effectively been mined, and clearing naval mines is a slow, dangerous, specialized operation that cannot be completed in days. Even if Islamabad talks produce a perfect agreement on paper, Hormuz will not be functionally open at normal capacity for weeks or months, because the physical infrastructure of mine clearing takes time regardless of political will. The institutional trading desks running commodity models understand this distinction. They know that oil markets priced in significant ceasefire optimism when Brent fell from $100 to $111 to approximately $95 to $96. They also know that the actual Hormuz reopening timeline, even in the best diplomatic case, is measured in weeks, not days. That means oil has been over-discounted relative to the actual physical supply normalization timeline. When that over-discount becomes undeniable, when week 2 of the ceasefire shows Hormuz is still at 5% of normal capacity, oil bounces back toward $100, regardless of diplomatic progress. And an oil bounce toward $100 takes silver's rate cut narrative with it in the wrong direction, pushing silver back toward $70 to $72, even if Islamabad technically succeeded. This is the hidden trap in the current market setup that institutional traders are modeling and retail investors are not. Now, let me show you the Lebanon-Kuwait-Iran triangle that institutional analysts are treating as the most likely mechanism for ceasefire collapse, and why it is more advanced in the collapse direction than mainstream media is reporting. Iran has stated 2 formal preconditions that must be met before Islamabad negotiations can formally begin. First, a ceasefire in Lebanon where Israel's ongoing airstrikes on Hezbollah must stop. Second, Iran's frozen assets, estimated at approximately $7 billion, must be released before talks commence. Neither precondition has been met as of Saturday morning, April 11th. In the 24 hours before the Islamabad talks began, Israel struck 120 Hezbollah targets in Lebanon. Lebanese Health Ministry confirmed over 357 deaths during the supposed ceasefire period, making this one of the deadliest periods Lebanon has experienced in months. Iran's parliament speaker Ghalibaf stated in formal pre-negotiation communications that these strikes constitute ceasefire violations and that 2 mutually agreed measures remain unimplemented. Separately, Kuwait formally accused Iran and its proxy network of launching drone attacks on Kuwaiti territory Thursday night, the night after the ceasefire was announced. Iran's Revolutionary Guard denied it, but the accusation itself creates a problem. If U.S. intelligence confirms the Kuwait drone attack was Iranian proxy-sourced, the Trump administration faces domestic political pressure to declare the ceasefire violated and resume strikes. If the administration ignores a confirmed Iranian proxy attack on a U.S. ally to preserve the Islamabad talks, it faces accusations of weakness that are politically toxic. This is the triple bind. Lebanon strikes giving Iran ceasefire violation justification. Kuwait drone allegation giving the U.S. ceasefire violation justification. And Islamabad talks requiring both sides to ignore their respective justifications for at least 48 to 72 hours to allow negotiations to proceed. Institutional traders are modeling this triple bind as giving the ceasefire approximately 40% probability of complete collapse before Monday morning, 35% probability of stalling without collapse, and 25% probability of producing meaningful preliminary framework. Those probability weightings are not publicly published anywhere, but the derivatives markets, specifically options on silver, gold, and crude oil, show implied volatility pricing that is consistent with institutions assigning exactly that probability distribution to the weekend outcomes. Here's the silver options market data that reveals what institutional traders are actually betting on for Monday's open, because options markets are the most honest expression of institutional conviction because they require real capital at risk. Silver implied volatility, the options market's measure of expected future price movement, has been elevated all week and remains elevated into the weekend. At the money silver options, expiring next Friday, April 18th, are pricing in a potential weekly move of approximately plus or minus $6 to $8 from current levels. That range, $67 to $68 on the downside, $81 to $83 on the upside, is what the options market as a whole believes contains roughly 68% of possible outcomes for silver over the next 7 trading days. The put-to-call ratio on silver options, or the ratio of bearish bets to bullish bets, is currently elevated above its 30-day average. More institutions are buying downside protection on silver than upside participation. This asymmetry tells you that institutional players who are long silver from lower levels are hedging their positions with puts. They are not selling their core positions, but they are paying for insurance against a gap down on Monday. The cost of that insurance is the out-of-the-money put options that institutional risk managers have been accumulating through the week. If silver gaps down Monday on Islamabad failure, those put options print massive gains that offset losses on core long positions. If silver gaps up on Islamabad success, the put options expire worthless, but the core long positions generate profits that more than compensate. This options positioning tells you the institutional stance. Core long positions protected by downside hedges. They are not selling silver, they are insuring it. That is a different posture than retail investors who are either fully exposed or fully out. Here is the specific tactical playbook I believe institutional trading desks are executing for Monday morning based on the sum of everything I have described. Step 1. The first 15 minutes of Globex opening Sunday night are for price discovery. Institutional algorithms will immediately test key support and resistance levels to see where liquidity exists. If the Islamabad outcome is positive, algorithms will probe the 77.73 resistance, the descending trend line from January and the cut pattern breakout trigger. If liquidity above 77.73 is thin, meaning there are few sellers willing to sell at that level, the algorithms will push through it aggressively, triggering stop buy orders from retail traders who set buy stops above resistance. That cascade of triggered buy stops amplifies the gap up move beyond what the Islamabad news alone would produce. If the Islamabad outcome is negative, algorithms will probe the $74.50 support level, the weekly EMA 17. If liquidity below $74.50 is thin, meaning retail stop-loss orders cluster just below that level, algorithms will push through it, triggering a cascade of stop-losses that amplifies the gap down beyond what the news alone would produce. This is not conspiracy. This is documented algorithmic market structure behavior that occurs at every major support and resistance level in every liquid futures market. Knowing this happens is preparation. You can either be the retail trader whose stop-loss triggers and provides liquidity to the cascade, or you can be the trader who understands the cascade is coming and positions to benefit from it rather than be victimized by it. Step 2. After the initial Globex probe, institutional physical buyers enter. If the gap down scenario played out and silver is trading at $71 to $73, physical buyers who have been waiting for sub-$75 prices will begin accumulating aggressively. Shanghai dealers will expand their already elevated premiums, currently 12% to 13% over COMEX, to 18% to 20% as Asian physical buyers recognize the paper price discount as a buying opportunity. The physical buying establishes a floor that prevents paper prices from collapsing further than the algorithmic cascade initially pushes them. Step 3. By Monday mid-morning, the dust settles and the actual fundamental picture reasserts itself. Whether silver gapped up or down Sunday night, the 6-year supply deficit, the COMEX delivery pressure with 8 days to May 1st notice, the 820 million ounce cumulative shortfall, and the sovereign accumulation programs by Russia, India, and Saudi Arabia are all still true. The gap was driven by geopolitical sentiment. The recovery or continuation is driven by structural fundamentals. Here is what you specifically should do this weekend knowing this institutional playbook exists. First, do not put stop-loss orders at obvious technical levels. The $74.50 and $73.50 support levels are where every retail trader's stop-loss is clustered. Institutional algorithms know this, Putting your stop exactly at $74.50 means you sell into the cascade, not before it. If you need downside protection, either use options, where your maximum loss is defined and you cannot be stopped out below your level, or place your mental stop at a non-obvious level like $73.80 or $72.20, not the round number or the exact EMA level that everyone is watching. Second, do not chase the gap. If silver opens $5 higher Sunday night because Islamabad talks produced preliminary framework, do not buy immediately at the gap open price. The initial Globex move typically overshoots in the gap direction before finding equilibrium. Wait for the first 30 to 60 minutes of trading to establish whether the gap is holding or retracing. Buy the first pullback from the gap level, not the gap itself. Third, size your positions before Sunday night based on the worst case scenario, not the best case. If silver gaps down $8 to $68, can you hold your position without being margin called or without being emotionally destroyed? If not, you're overpositioned. Reduce to a size you can hold through the worst case before Sunday night's open. Fourth, watch the Shanghai Premium Monday morning. If silver gaps down, but Shanghai Premium expands from 13% to 18% or 20%, it tells you physical buyers in Asia are using the gap down as an accumulation opportunity, which is the most reliable signal that the gap down is not the beginning of a sustained downtrend, but rather a buying opportunity before the structural thesis reasserts. Here is the bottom line for this Saturday, April 11th, 2026. The institutions are planning for Monday's open right now, while silver markets are dark. JP Morgan, with 750 million ounces in COMEX positions, is hedged for both outcomes and positioned to profit from the volatility regardless of direction. Managed money reduced 5,000 contracts this week. Selling into the ceasefire rally and waiting to redeploy after the binary event confirms direction, options markets are pricing $6 to $8 weekly move potential, with elevated put-to-call ratios showing institutions buying downside insurance rather than selling core longs. Hormuz is still 97% closed, with 2 ships transiting Friday versus 150 normal, a detail that oil markets have not yet fully repriced. The Lebanon-Kuwait ceasefire violation triple bind gives both sides justification to abandon talks before they produce results. The algorithmic playbook for Sunday night's open will probe key support and resistance levels to trigger retail stops in whichever direction provides the most liquidity to institutional positioning. Understanding all of this does not guarantee you make money Monday. But it does guarantee you are not the retail trader who sells their stop loss into the cascade, chases the gap at the worst price, or panics out of a structural position because of a geopolitical sentiment move that institutions are already hedged against. The weekend warning is this: they are planning for Monday's open right now. The only question is whether you are planning too.